Okay, let's dive right into this explainer by talking about a feeling pretty much every single crypto investor knows intimately. You know the one. It's that sudden, massive adrenaline rush you get when you open your app and see a coin's chart going completely vertical. I mean, you see this giant green candle shooting straight up, your heart starts pounding, and you can't help but think to yourself, wait, is this it? Is this my big chance to finally catch a moonshot? But here is the million-dollar question we really need to pose today. When you see that massive green candle, are you looking at a genuine, fundamentally driven market opportunity, or are you walking straight into a perfectly laid snare? Because let's be real, in today's crypto market, what looks like a glorious breakout is very often a meticulously engineered trap. To see what I mean, just look at the wild volatility of a token called Whalebit, or CES. This is basically our textbook example of dizzying highs and absolutely crushing lows. Based on market data, CES hit an all-time high of $7.08. Pretty great, right? Well, it then plummeted to an all-time low of just over 7 cents. Sure, the coin has seen some recent daily jumps of maybe 8 or 9%, but that massive historical drop highlights the sheer terrifying volatility that defines these types of low-cap tokens. It's exactly the kind of chart that draws you in with the promise of crazy riches, but usually just leaves everyday traders left holding the bag. Section 1. The anatomy of hype. So there is this fundamental core conflict playing out on the charts every single day. You've got the genuine excitement of retail traders creating a massive wave of demand, and then you've got large holders, the whales, using that exact wave as their personal exit ramp. And this dynamic, it plays out flawlessly in environments with low liquidity. When you have a shallow order book and barely any active buy and sell orders, there literally just isn't enough trading volume to absorb large sudden moves. And this is exactly why low liquidity is so incredibly dangerous. I mean, a single massive order from a whale can violently manipulate the price. We're talking brutal slippage and severe whiplash-inducing volatility. This is the absolute perfect breeding ground that bad actors hunt for when they want to set up their pump and dump traps. Section 2. Inside the whale trap. Now, make no mistake, this stuff is not random. It is a highly sophisticated, step-by-step playbook practically designed to weaponize your own emotions against you. Step 1 is accumulation. While absolutely no one is watching, insiders quietly buy up huge bags of a low-liquidity coin when it's dirt cheap. Step 2 is the narrative. They craft a simple, punchy story. You know, this is the next Bitcoin, or this token powers a revolutionary new metaverse. Step 3 is amplification. They blast that story everywhere across social media, using influencers and bots to manufacture the illusion of this massive, unstoppable grassroots movement. And finally, step 4, distribution. As retail FOMO hits a fever pitch and everyday people start frantically buying, the whales do the exact opposite. They start distributing their holdings right onto the retail crowd, walking away with massive profits. Let's look at a real-world example, because this happens all the time. Remember that crazy surge with the Uniswap token? A massive headline dropped claiming BlackRock was using Uniswap for a new fund. Retail traders got hyped, the price went totally parabolic, shooting up over 40% in a single day. But guess what? The news was completely fake. And while retail was buying into the frenzy, whales looked at that 40% surge as a giant flashing exit sign. They dumped $27 million worth of the token onto the market in just one day. The trap was sprung perfectly. And look, we have to acknowledge where all this pressure actually comes from. Studies are showing that moderate to high levels of FOMO, that fear of missing out, is basically the norm for crypto traders now, not the exception. And social media, it is literally the 24/7 fire hose manufacturing all that urgency. It creates this intense herd mentality where you just naturally assume, hey, if everyone in my timeline is buying, they must know something I don't. But wait, it gets worse. Even after the trap is sprung and the price comes crashing down, these manipulators usually have one final trick up their sleeve, the infamous dead cat bounce. They'll engineer a small, sharp recovery just to prey on your hope. It creates this cruel illusion of a turnaround, sucking in one last wave of desperate buyers before the price just continues its long, ugly fall to a new, devastating low. Section 3. Altcoins are actually cooling. So if we want to be smart investors, we have to actively shift our focus away from the artificial hype of these tiny coins and look at objective, data-backed reality. When you actually contrast the aggressive, scream it from the rooftops narratives of low liquidity tokens with what the top-level altcoin market is doing, a much more rational and, frankly, somewhat drier picture starts to emerge. The really crucial point here is that the broader altcoin market cap, and we're excluding the top 10 major assets here, recently hit a high of roughly $195 billion. But since then, it's actually retreated to the $185 billion range. This move reflects a very normal, short-term correction after a period of rapid expansion. The real market is actually entering a cooling and consolidation phase. It's just seeking balance after all those aggressive capital inflows. You can see this perfectly illustrated right now with Arbitrum, or ARB. Despite cooling momentum, it is maintaining a solid bullish structure by holding steady right above a critical support zone of 12.5 cents. If you look at the momentum indicators, they're telling a story of a market taking a pause, not exploding. The relative strength index has drifted down into neutral territory, and the MACD indicator is actually showing a bearish crossover, pointing to some short-term selling pressure. This proves that the real, mature market is currently just taking a breather. It's assessing its next direction, completely detached from those manufactured, straight up and down vertical charts of the hype coins.
Section 4. Spotting the real signals.
All right, so how do we actually cut through the noise? You need to track what genuinely moves the market today. The game has grown up, and we've got to grow with it. Instead of obsessing over social media chatter, smart investors are watching three massive macro drivers: global liquidity, institutional flows coming in through ETFs, and on-chain demand. Specifically, they're looking at stablecoin supply that's just sitting on the sidelines waiting to be deployed as buying power. You can completely replace all that emotional guesswork with concrete data using this really simple framework. Think about it. In a true bull market, you are going to see a rapidly rising stablecoin supply paired with consistent, steady cash inflows into ETFs. In a bear market, the exact opposite. Stablecoin supply shrinks, and ETFs are bleeding cash. And in a sideways, choppy market, you'll just get mixed signals without any clear trend. Guys, this is the data that actually matters, not the coordinated spam filling up your timeline.
Section 5. The Smart Trader Checklist.
Let's be honest, the old checklists of just making sure a project has a fancy website, that simply doesn't work anymore against today's highly sophisticated traps. So here is your essential mental defense strategy. Run through this before you invest a single dollar. Number 1, question everything. Be deeply, stubbornly skeptical of anyone promising guaranteed 100x returns. Number 2, spot the spam. If you're seeing the exact same hype message everywhere, that's a coordinated red flag, not a grassroots movement. Number 3, analyze the motive. Always ask yourself, who really benefits from me buying right this second? Number 4, separate the signal from the noise by focusing on that liquidity and those institutional flows we just talked about. And finally, absolutely critical, always have a strict plan. You need to know your entry point, your profit target, and your stop loss before you ever click buy. Because at the end of the day, in a market that is just flooded with noise, your absolute best tool isn't some expensive secret indicator or a hot tip from an influencer. Honestly, it's just your own awareness. The ultimate advantage you have against these sophisticated market traps is simply recognizing the psychological games being played right in front of you and consciously choosing not to participate. So, I'm going to leave you with this one thought. The next time you open up your app and you see a chart starting to go completely vertical and you feel that powerful, undeniable FOMO kicking in your gut, what will you see? Are you going to see a once-in-a-lifetime opportunity? Or will you pause, take a deep breath, and look for the hidden signs of a trap? The choice and the awareness is entirely yours.